Hello, you're watching Deal Flow, the show that tracks merger and acquisition activity in Africa and beyond. I'm Erica van der Merwe. Thanks for joining us. Now, with the recent completion of its acquisition of the Protea Hospitality Group, Marriott International became one of the largest hotel companies in the African region. Interest in the hospitality industry certainly is hotting up in many African countries. Now, who are the likely long-term winners? Which are the prized assets? And what will it take to succeed in this region? In studio with me, Marcel Von Aulock, CEO of Tsogo Sun, Kamil Abdul-Karrim, Managing Director of Pam Golding Tourism and Hospitality Consulting, and Gillian Saunders. She's Principal and Head of Advisory Services at Grant Thornton. Lovely to have all three of you here. And I know you're very much au fait with the industry. Marcel, I'm going to start with you. So you're the operator, you're the doer. So the hook has been the Marriott deal, but Soho San itself has been pretty active in its own right with expansions, acquisitions. What have you been up to in the last 2 years or so?
Yeah, so we're quite different to Marriott in that we own the assets as opposed to providing management services or consulting services to the industry. We've put a lot of capital into the hotel business, which is one of our businesses. Obviously, we've got gaming and we've got hotels. In the last 2 or 3 years, we've probably spent close to 2 billion rand on buying up hotel assets, mainly assets that we already ran for third parties. So we bought the remaining share of the Formula One business, which we've rebranded as Sun One. We bought a hotel in Nigeria that we were operating under management contract for about 700 million. And we've just announced the deal where we're buying a number of hotels into a joint venture that we have with Liberty. We like to own the assets. It gives us long-term tenure. And ultimately, we prefer to deploy the skills and resources to running it for our own account, which is quite different to many of the international operators who sell consulting services or management services and take a small fee from each hotel that they operate.
Gillian, could you talk us through that choice to have that separation in international operators between ownership and management?
It's been something they've been doing for many, many years, actually, called going asset light. And even when they were a Soho model and they used to own the assets, they'd often eventually go into a sale and leaseback type of agreement, but it wasn't leaseback, it was management contract. So as Marcel says, the asset owner actually pays the management company to operate on their behalf, and the management company charges them a fee. You can expand faster doing that. You can concentrate on the skill of operations as opposed to property management and facilities management. In fact, Accor, which is the biggest global group, recently split their property business from their hotel operation business. They've kept it all, same shareholders, but they split them because they said the skills needed are different. So that's usually the rationale behind doing it. You can easily take on new properties because you need somebody else to own and invest in that property, and you go along and strike the deal to manage it, put your brand on it.
Kamil, what do you think is going to be the model for expansion in the African region? I understand it's difficult to get in, the number of assets is limited. So perhaps if you want to be fleet-footed, you need to have that separation, but you still need to build assets.
Exactly. I think one of the big issues in Africa is, especially in major trading centers, and I would call it Lagos, Luanda, DRC, Kinshasa. I think if you look at those kind of regions, there are a lot of hotels, but the opportunity exists for branded hotels. I think the point is often made, I paid $500 a night in a 5-star hotel. It was nothing better than the three-star South African standard. So I think for branded hotel operating or hotel management companies to come into Africa, there's tremendous opportunity. But the flip side to that, which is very different to Marcel's business or Soho's business, is that you have to place a lot of trust in your partner that's developing the hotel. So if I was Residor, for instance, I would have had to place a lot of trust in the developer. And that's where a big issue comes up. There's a lack of equity in Africa. There's a lot of promises. So, you know, I tried to ask some of the operators before this discussion, what is your success factor in Africa? Is it 1 out of every 10 projects you look at? And nobody's prepared to talk about that because it just depends. It differs from region to region.
So, Gillian, it sounds as though Marriott got a good deal if it managed to find assets on the ground in the African region in the form of Protea. There, it's pushed up to first place.
Overall, it was a good deal, or it was a slightly bad deal for both parties, so everybody's slightly unhappy, and that's a good place to be. But Marriott, like most of the international brand, really, they want a footprint in Africa. They're seeing it as a new frontier. It's got to grow economic growth. The resource base is proving a driver of economic growth, of infrastructure growth. And they're underrepresented, like Kamil said. The brands are underrepresented. So Protea had 516 hotels, of which about 37 were in sub-Saharan Africa, the rest in South Africa. Marriott has about 3,900 globally, only 10 in Africa and 9 out of the 10 in North Africa. Put them together, the biggest hotel group in Africa, largest number of properties, and the biggest future pipeline of properties that they're already negotiating or being built by the investors.
Did they overpay for the asset?
Well, I said they're both unhappy, or that's what they say. It was probably fairly expensive, 10 times projected EBITDA is what we understand, to around 2 billion rand, yeah. And because it was obviously a rand-denominated deal, it's got more expensive for Marriott through to final conclusion of the deal, which was 1st of April as we understand it. But they did get a lot of properties. So now they've got the synergies in Africa that they can use their reward system on, they can use their central reservation system on. And I think you maybe get the best of both worlds. One of the other challenges we often say to the big international brands is their brand spec is very tight. And when they try and put it down on Africa, it doesn't always work. By that I mean size of room, level of service, a whole bunch of things. So we've said to them, but don't you need to modify your brand and your delivery for Africa? And they say, no. But they're going to keep the Protea brand, Marriott. So the Protea will be actually an African brand within the Marriott stable, which will sort of address that little bit more flexibility you perhaps need to operate on the continent.
Marcel, are you willing to comment on the Marriott strategy for Africa? And could you add on to that what your own Africa strategy is outside of South Africa?
I can see why it's attractive to Marriott, because they do get distribution in countries where they don't have people. So they have to go. To start in Lagos is hard work. If you've never been there and it's like a darkest Africa and you've got to go into this thing, it's hard work to go in. So I can see why it's attractive to them, but it's actually a relatively small business they're buying. I mean, if it makes a projected 200 million EBITDA, we've got 2 or 3 hotels that will make that in one go out of 90 hotels. So it's purely a distribution system and a brand system. They don't get the assets. The assets were carved out of the deal. And Marriott doesn't want assets. They split that out in early 90s already. So it's a consultancy type arrangement. The challenge with Africa is going to be who's actually going to put the bricks and mortar into the ground. We find in most cases it's either unusually large institutions like us are prepared to do it in Africa, and there are not globally many that will do that, or it's wealthy individuals who know the countries and know the environment and are able to work in it. And there are lots of those. The other thing that we find is that the asset light versus asset heavy approach is very country specific. So in South Africa, it's quite difficult to compete with brands like the Soho San brand or the City Lodge brand, which have a very entrenched market presence, a very well-defined database and so on. It's like trying to compete with Accor in France. So the places where the asset light companies do well is when they go into totally untapped markets, areas that have no local hotel chains. I wouldn't have the guts to take on Accor in France. We can take on Accor elsewhere. But if you've got that local market advantage, so I don't see Marriott ever changing the Protea brand in South Africa, for example, because it's got so much value here. It's very much like the Soho San brand or the City Lodge brand. Africa will open up, but the markets are relatively small, which I think at the moment there's a lot of hype around Africa. But in many of these cities, if you add 200 or 300 rooms to that market, you go from undersupply to oversupply almost immediately. Whereas you could add 200 or 300 rooms to Sandton and no one would actually notice. So people talk Africa, but it's a very difficult, very slow rollout process. I mean, not to be nasty to them, but many of the internationals, when they say they're going to have 50 hotels and 5,000 rooms in 5 years, they can't name you 5 African cities. So there's a very long way to go before you get this big rollout into these places.
So Kamil, does that mean it needs to be a cautious, as you use the term rollout, a cautious to avoid oversupply and then an impact on pricing?
Agreed. Although there are certain developmental nodes in Africa which are fairly different.
And they are?
In Angola, for instance, Soyo has got massive fuel and gas reserves that are now being untapped. Pemba in Mozambique. So these are growth areas that are coming into the marketplace. And then there's those traditional markets that have been totally overlooked because of political complications in the past. Kinshasa is one example. Your best hotel is a 5-star hotel that really doesn't stand up to it. So yes, one needs to tread cautiously, and I think ultimately there are going to be more and more opportunities to convert, because poorly operated hotels in cities like Luanda, in areas like Lagos, are going to feel the pressure of a Soho Sun or a Marriott coming into those markets. So there's going to be more and more opportunities from that perspective, but it depends structurally whether they can be refurbished.
So Gillian, Kamil used the term convert. Is this sort of speak in your industry for consolidation? So going with a brand or certain acquisitions going on?
It's really more that there's a lot of independent hotels in the African cities. They've come up through small local entrepreneurs building and developing hotels, sometimes even 2 or 3. They've got small chains. The other is that there's an unfortunate thing where historically a lot of nationally owned hotels were owned and operated by governments, and they built a hotel and they made it a Sheraton, and that's what they did in Kinshasa. And then later on, Sheraton eventually pulls out because the asset isn't maintained by government, as in those old communist-style governments. And they are now operated locally, either by government sometimes or by independents who got involved, but the standard has gone totally downhill. So you need to convert it up to what it should be, the real 5-star standard it should be. And sometimes it's convert other buildings. But in order to sort of get a head start on getting your hotel developed, it's sometimes easier to look at a conversion than a greenfields build. A greenfields build is really challenging in Africa, and the costs of construction are also very high, and the time frames tend to be long. And again, as was alluded to by Kamil, is that partnership and who is your local stakeholder or your local equity partner, and having a good relationship with them. They may have made their money as high net wealth individuals in something else, but they often just don't understand hotels, and there starts to be head knocking when you start arguing about, but the bottom line isn't quite what the budget said.
Yes, yeah.
Well, I'm sorry you don't get your money because there's a management contract, and it's not like a lease where you earn the rent no matter what.
Right.
You earn less if the hotel's not doing as well.
Marcel, this certainly is the theme we're hearing in all industries who penetrating the African continent, needing to understand the local market. It's different from what you're seeing in developed markets. I'm just thinking of your analogy with Marriott wanting to do its own cookie cutter way. It may not work in this region. So if you could summarize, Marcel, who would be the winners in this market? It still seems to be a market for the taking, but small.
Yeah, it's growing, so that's why we're in it. And we operate, I think, in 8 different African countries. But it's one you have to tread carefully, and you've got to be in a considered way. Just something like the room rates. There's a lot of talk about the price of hotels in Africa, and we all refer to the Nigerian example where you get $500-600 a night. Up until the recent rand weakness, our room rates in our African hotels were lower than our South African rates. Your general 4-star Soho San core branded product was doing about $140, which at 8 to the dollar was less than what we were getting in South Africa out of that. So it wasn't necessarily enormously lucrative relative to the local market, and it cost about twice as much to build new hotels. Well, you very slowly, you didn't go into in a big rush. And every market's different. I mean, in the 10 years I've been involved in this, I've seen Dar es Salaam go from an ultra high rate market to a much lower rate market, and Maputo go the other way, where it was actually a very depressed market, and it's incredibly strong at the moment. So the only people that are going to win this are the ones that really spend the time doing the homework and go slow and steady and understand the local rules, understand the market dynamics, and ultimately, we believe, own the properties, because you've got to have real cash in the ground to make the return out of the thing.
Marcel, Kamil and Gillian, thank you so much for your time and your insights. Certainly plenty happening in the sector, not only in South Africa, but across the African region. Marcel Von Aulock is from Tsogo Sun, Kamil Abdul-Karrim is from Pam Golding, and Gillian Saunders from Grant Thornton. From me, Erica van der Merwe, goodbye. Thanks for being with us.